Friends, please immediately put down everything in your hands because an event sufficient to subvert the financial markets has exploded in the financial circle. Before speaking of this news, let me first ask you a question. Have you ever thought about what it would mean when the world S3 most authoritative precious metals exchanges, London LBMA, New York COMEX, and the Shanghai Gold Exchange, almost at the same time and by coincidence, send out the same signal? That signal is we do not have enough silver and we cannot deliver the goods. Imagine that you are a hedge fund manager worth tens of billions. On the 5th of January, 2026, you hold a long position in silver futures worth $500 million. According to the contract, you now demand physical delivery, planning to transport this silver to your newly completed photovoltaic module factory in Southeast Asia. However, when you dial the phone of the designated delivery warehouse of the London Bullion Market Association, LBMA, the other party, S voice is as cold as ice. Sorry, sir, we currently have no inventory to pay. According to emergency clauses, we can only provide you with a cash settlement. You roar in anger. I don't. You want paper money? I want physical silver bars. The other party is silent for a moment and says something in a low voice sufficient to make your spine turn cold. Sir, the current situation is that even if you take the entire Federal Reserve to exchange, the physical inventory of the whole world cannot make up the number you want. Silver has physically disappeared on this planet. Yes, you did not hear it wrong. In just these first few days of the opening of 2026, an unprecedented delivery crisis is simultaneously exploding in the heart of the global precious metals market. London, S vaults are empty, New York, S warehouse receipts have hit bottom, and even the always wealthy Shanghai has quietly closed its doors to external physical redemption. What does this mean? It means those short, selling big shots who called the shots on Wall Street and would smash the market with billions of dollars are now like ants on a hot pan, frantically looking for silver all over the world to fill their holes, only to find that the physical silver on the entire earth that can be brought out for delivery has been sucked dry. And within these 72 hours, the silver spot price has soared directly from $71 to over $77, and some Asian markets have even reported transaction prices of $80 or even higher. This is not an ordinary price increase, this is an epic short squeeze 2.0 currently being staged. This is the most insane and thrilling moment in the global silver market since the Hunt Brothers event in 1980. And what I want to tell you today is not just the truth of this storm, but more importantly, in this storm, how you as an ordinary investor can avoid traps, how to find that golden pit. That belongs to you, and how to pick up those bloody chips in the middle of the bloody storm where institutions kill each other. Have you been tossed by the market until you are almost going crazy? Are you watching the silver price go up and up, feeling an itch in your heart, but not daring to chase? Did you just rush in wanting to buy the bottom, but as a result, a correction threw you off and you left the market by cutting your losses? Hello everyone, welcome to the Gold Strategic Analysis Bureau. Like first, then watch. The content is wonderful and full of dry goods. Before answering the questions, I will first tell you a story. The protagonist of this story is not a mysterious financial tycoon, but a term you may have never heard of called deliverable inventory. What is deliverable inventory? Simply put, it is the physical silver that meets exchange standards and can truly be brought out to be delivered to buyers. Please note, I am saying physical, the kind of white one. By one silver bars that you can touch and hold, not the numbers on the screen, not the promises on the futures contracts, but true and real metal. Now let me tell you a set of data that will make your hair stand on end. London LBMA, the world's largest physical silver trading center. Its deliverable inventory now has only 233 tons left. What kind of concept is this? This is only equivalent to 18% of the peak period in 2019. This bit of inventory cannot even meet one day S clearing demand New York COMEX, the world's largest silver futures exchange. Its registered warrants, which are the silver certificates that can be used for delivery, have fallen to a historical low point, a full 60% lower than in 2020. And what is even more shocking is that the Shanghai Gold Exchange, this Eastern giant known for physical as king, has quietly closed the channel for external physical redemption in order to prevent being run on by external funds. Friends, do you understand? The three major global exchanges at the same time use different methods to send out the same distress signal, which is, we have no silver. What does this mean? It means those institutions selling silver short orders on the futures market, those Wall Street big shots who counted on using a piece of waste paper to suppress the silver price, are now facing an unprecedented predicament. They must hand over real silver within the specified time. But there is simply not enough silver in the entire market for them to hand over. This is like a group of people writing bad checks wildly, and suddenly one day all the creditors come to the door at the same time to collect the debt, and they find there isn't a penny in the bank account. Why does this situation occur? Because the rules of the game on Wall Street were a huge scam from the very beginning. Let me explain to you what paper silver is. In the futures market, every silver contract should theoretically correspond to a certain amount of physical silver, but in reality, according to the latest data, every ounce of physical silver in the COMEX market corresponds to about 360 pascals per S silver contracts. This is like a bank vault having only $1 but issuing $361 bills. As long as not everyone comes to withdraw money at the same time, this game can continue. The bank can use newly deposited money to deal with those who come to withdraw money, and then continue to issue more banknotes. But the problem is, this game has a fatal loophole. Once everyone no longer trusts you, once everyone demands redemption at the same time, this game of passing the parcel will instantly collapse. And now, this moment of collapse has arrived. Why do I dare to say this? Because 4 unprecedented events happened simultaneously in these first few days of the opening of 2026. First, China officially launched a one order, one province control system for silver exports on the 1st of January, 2026. What does this mean? China is the world's largest silver producer and processing exporter. More than 11% of global silver production comes from China. Now, the Chinese government has promoted silver to the level of a strategic material. Only 44 enterprises have obtained export qualifications, and every single order of export needs separate approval. This is no longer the previous quota system, the kind of gameplay where you could get a quota if you paid money. Now, the Chinese government can tighten the faucet anytime and anywhere it wants. The market expects that this policy alone will reduce global silver supply by 4,500 to 5,000 tons. What kind of concept is this? The global silver market was originally already in a supply shortage for 6 consecutive years, with an annual gap of about 3,600 tons. Now, with this cut from China, the supply demand gap in 2026 will directly soar to more than 8,000 tons. Second, the explosive growth of industrial demand has completely gone out of control. Silver is not like gold. If gold prices rise, Dama, middle-aged women can choose not to buy gold necklaces. But if silver prices rise, can photovoltaic factories stop production? Can new energy vehicle factories stop production? Can AI computing centers disappear? The industrial demand for silver accounts for more than 60% of total demand, and the demand for silver from the photovoltaic industry is growing at a rate of more than 20% per year. Those conductive silver pastes, those dense silver lines on solar panels, each one is devouring the already scarce silver inventory in the market. The world's top 10 photovoltaic enterprises have united to establish a silver reserve pool, locking in the silver paste supply for the next 3 years in one breath, locking up 15% of global silver production. Tesla, Siemens, and Samsung. These industrial giants are frantically hoarding silver like they were grabbing toilet paper in 2020, because they know that once the supply is cut off and the factory stops production, the loss of one day might be 10 times the price of the silver price doubling. This panic hoarding is sucking the remaining liquidity in the market dry, drop by drop. Third, the short squeeze spiral has officially started. In December 2025, in just the first 4 days, 60% of deliverable silver was taken away. Under normal circumstances, how much is this number? 1 to 2%. This means someone is extracting physical silver on a large scale, moving the silver bars that were originally lying in the exchange vaults to support the operation of the futures market away box by box. Who are these people? They might be smart money smelling danger, industrial buyers preparing for a rainy day, or long side giants intentionally trying to squeeze the shorts to death. But no matter who it is, the result is the same. The institutions holding huge short orders now find they simply cannot find silver for delivery. They have only 2 choices: either buy physical silver from the market at a high price and complete the delivery with a stiff upper lip. The result of this is further pushing up the price and intensifying the short squeeze, or pay a high premium to borrow silver from others. Now, the silver lease rate has soared to 5.9%, while under normal circumstances it is only 0.5%, which means the cost of borrowing silver has exploded more than 10 times. No matter which path is chosen, it is a dead end for the shorts, and their death will become the fuel for the long side. Carnival. Fourth, and the most critical point, spot and futures prices have begun to split. The silver price you see on the screen, such as the current $77, is the futures price, the price of paper silver. But if you really call a refinery or go to a gold shop and ask them how much it costs to buy a real silver bar, $80 minimum, and there might not be stock. Some Asian markets have already reported physical transaction prices exceeding $80. This divergence between spot and futures prices is called a dual track system. This is an extremely dangerous signal. It means the futures market is losing the pricing power over the physical market. It means those paper silvers are turning into a pile of waste paper without physical support. It means the rules of the entire game are being rewritten. Let me use a more common metaphor to explain what this means. Suppose you bought a concert ticket with a face value of 1,000 yuan. According to normal logic, you can enter the venue to watch the concert and enjoy the singer's performance with this ticket. The value of this ticket comes from the real experience. It can be exchanged for. But now the organizer suddenly announces, "Sorry, the venue capacity is limited. We sold too many tickets, and not everyone can enter. Your ticket is still worth 1,000 yuan, but we can only refund you 800 yuan in cash, and the rest is your bad luck." At this time, the scalpers at the door have a few tickets that can really get in. How much will they sell them for? 2,000, 3,000, 5,000. As long as someone wants to go in, there is no upper limit to the price. The current silver market is in this situation. Those holding futures contracts hold a letter of commitment, a promise that says physical silver can be redeemed. But when the exchange tells you, "Sorry, we don't have that much silver, you can only settle in cash," your promise turns into waste paper, and those who truly hold silver bars in their hands, they are the true winners in this game. This is why I say an epic short squeeze is being staged. You might ask, has such a thing happened in history? Yes, and that time was even more insane than now. In 1980, the Hunt brothers from Texas, USA, united with some members of the Saudi royal family, controlled 53% of global silver warehouse receipts through large-scale hoarding. They pushed the silver price all the way from $11 to $50.35, an increase of over 350%. That time was also because the shorts in the futures market could not deliver and were forced to buy at high prices to close positions, forming the same short squeeze spiral. The entire Wall Street was shaken. Eventually, the U.S. government had to intervene, change the rules, and forcibly stop trading to barely control the situation. And now, this time in 2026 is even more fierce than 1980. Why? Because in 1980, only the London market had a problem. But now, London and New York, the two largest global exchanges, are simultaneously in distress, and Shanghai directly closed its doors for self-protection. This is the fall of three markets at the same time. This is a global silver panic. If you feel what I said today has touched you and given you a brand new understanding of the market, please take 1 second to give a like and a follow, because what I'm going to tell you next is more core content, which is what you should do in this storm. When a crisis comes, the most terrifying thing is not the crisis itself, but that you do not know the crisis exists. And once you see the essence of the crisis turns into opportunity. Let me first tell you the several most likely outcomes of this short squeeze storm and what each outcome means for you. First possibility, the shorts admit defeat and continue to buy to close positions, and the silver price flies to the sky. This is the most direct and most likely situation to happen. When those institutions holding huge short orders find they simply cannot find enough silver for delivery, they have only one choice, which is to buy to close positions regardless of cost. What does regardless of cost mean? It means they buy at $80, they buy at $90, and they still buy at $100. Because if they don't buy for delivery, the consequence of default is even more terrifying. It means their credit is bankrupt, and they can no longer stand in the market. And this crazy buying will further push up the price, triggering more shorts to close positions, forming a self-strengthening positive feedback loop. This is the short squeeze spiral. In this case, where is the ceiling for the silver price? To be honest, no one knows. $80, $100, $150. When the market loses its rationality, everything is possible. Second possibility, the exchange modifies the rules and forces cash settlement. This is Wall Street's habitual trick and their most shameless move. When the game can no longer be played, they don't admit defeat, they change the rules. In 1980, they did exactly this. When the Hunt brothers squeezed them into a corner, the New York Commodity Exchange suddenly announced the launch of the so-called Silver Rule number 7, restricting margin trading, which was actually forced liquidation. As a result, the silver price plummeted 50% in one day. What if they repeat the same old trick now? The exchange might invoke emergency clauses to declare a state of force majeure and then tell you, sorry, we cannot provide physical delivery. Your contract can only be settled in cash at the current price. What does this mean? It means you clearly did the right direction and should have obtained silver worth $100, but as a result, you only got back $80 in cash. And when you take this $80 to go buy physical silver, you find the real silver in the market has already risen to $150. This is blatant legal robbery. This is like you winning the jackpot with a lottery ticket, and when you go to redeem it, the lottery center tells you the prize pool is empty and can only refund you the 2 yuan you paid for the ticket. Third possibility, regulation intervenes and forcibly limits positions. The U.S. Commodity Futures Trading Commission, CFTC, has already begun investigating the manipulation behavior in the silver market. If they determine that a short squeeze exists, they might take measures such as limiting positions, increasing margins, or even forced liquidation. This will cause violent price fluctuations in the short term. It might be a plunge or just a technical correction, but in the long run, this cannot change the supply, demand fundamentals. The silver price will eventually return to the upward track. Fourth possibility, and the most extreme case, physical delivery default and market trust collapse. If London's deliverable inventory continues to drop to below 100 tons, if the situation where the exchange truly cannot complete delivery occurs, that will be a trust crisis. The foundation of the entire futures market, the promise that everyone believes the contract can redeem physical goods, will fall apart. In this case, paper silver might crash because no one trusts those promises anymore. But at the same time, the price of physical silver will skyrocket to an unimaginable height, because only real gold and silver are true value. Those holding physical silver and those holding paper assets will live in two completely different parallel universes. So in the face of these 4 possibilities, what should you do? First, you need to be clear about one thing. What is the core contradiction of the current silver market? It is not a question of whether the Federal Reserve raises interest rates. It is not a question of whether the US dollar is strong, and it is not a question of whether inflation is high. These are all surface phenomena, smokescreens used by those analysts to fool you. The core contradiction is only one: too much paper silver, too little physical silver. This contradiction has been covered up by Wall Street using various financial tools and market manipulation means in the past few decades. But now, with the explosion of industrial demand, with the implementation of China's export controls, and with the continuous decline of global inventory, this contradiction has finally reached a point where it can no longer be covered up. It is like an upcoming volcanic eruption. The magma underground has boiled for too long, and the pressure has accumulated to a critical point. Every current price fluctuation is an attempt by the magma to find an exit. Once that breakthrough point is found, it will be a world-destroying explosion. And these few days of January 2026 are very likely that breakthrough point. Today, as silver bull, bear dividing line is in the range of $76 to $76.5. This is the battlefield where bulls and bears engage in short-range combat. Whoever controls this position controls the initiative next. If the price stands firm above $76.5, the bulls have the advantage, and the next target is the resistance area of $78 to $78.7. After the breakthrough, it is the $80 psychological barrier and the previous high. Once $80 is effectively broken through, it means a new round of the main upward wave has begun, with the target directly pointing to the historical high range of $83.5 to $84. Or even higher, if the price falls below $76, then be careful. The first strong support below is at $74.5 to $75. This is the first line of defense for the bulls. If this line of defense is also pierced, the next support is at $72.8 to $73. This is the final lifeline. But please note, the support levels I mentioned are not for you to buy the bottom, but for you to observe. In a short squeeze market, price fluctuations will be very violent. Any support level might be pierced in an instant and then recovered in an instant. If you rashly enter with a heavy position at these locations, you are very likely to be washed out. But I can give you a few reference anchors. The first anchor is $80. This is the high point of the round of short squeeze market in October 2025, and also a psychological barrier for many retail investors. Breaking through this position means the official start of a new upward cycle. The second anchor is $84. This is the historical high range and a strong technical analysis point. If the price can break through this position, it means silver will enter a completely unknown price base. And it also means the strength of this short squeeze might exceed the 1980 Hunt Brothers event. The third anchor is $100. This is an integer barrier and also a medium-term goal given by many analysts. Considering the global supply, demand gap has expanded to more than 8,000 tons, considering the long-term nature of China's export controls, and considering the rigid growth of industrial demand. $100 is not an unreachable goal. Of course, in this process, there will definitely be violent fluctuations and corrections that make you doubt your life, but as long as you see the general trend and keep your position, the final result will definitely satisfy you. Writing to this point, I want to say a few words from my heart to you. This market has never been fair. Those institutions with information advantages and those big shots who can participate in rulemaking are always several steps ahead of us ordinary investors. The news we see is often what they want us to see, and the decisions we make are often what they guide us to make. But this does not mean we can only sit and wait for death, or only be leaks to be slaughtered. Because the financial market has a most basic law, no matter how sophisticated the manipulation is, it can never forever resist the iron law of supply and demand. Wall Street can use paper silver to suppress prices, but they cannot create real silver. They can modify rules to cover up contradictions, but they cannot eliminate contradictions. When contradictions accumulate to a certain extent, and when the paper game can no longer be played, the truth will explode in the most violent way. This kind of explosion is often the best time for ordinary investors to achieve a leap in wealth. Now, this opportunity is in front of us. The simultaneous distress of the three major global exchanges is not an accidental event. It is a turning point of an era. It marks the paradigm shift from paper silver pricing to physical silver pricing, marks the historical transfer of pricing power from the West to the East, and marks the transformation of silver's identity from a speculative variety to a strategic resource. In such a major change, do you choose to continue to be a blindfolded lamb led by the nose by various true and false news, or do you choose to open your eyes, see through the essence of this game, and stand on the right side of history? If you choose the latter, then today, this article is your first step. I dare not say what I see is definitely right, and I dare not guarantee that if you do what I say, you will definitely make money. There is number 10 0% certainty in the financial market, and any investment has risks. But what I dare to say is that I have told you everything I know, and everything I understand without reservation. I have given you a complete logical framework so that you can verify and judge by yourself. This is much more valuable than those so-called great gods, who only shout slogans but never tell you why it rises and how to deal with risks. If you agree with my analysis style, and if you feel today as content is helpful to you, please be sure to like and follow. This is not just support for me, but more importantly, your like and follow can let more ordinary investors like you and me see this content, so that more people can find direction in this storm instead of becoming prey on the institution's dinner tables. Now let me summarize today's core points. First, the current silver market is experiencing an epic short squeeze market, the root of which is the redemption crisis that broke out simultaneously in the three major global exchanges. London inventory is only 18% of its peak. New York warehouse receipts have hit a historical low, and Shanghai has closed the external redemption channel. This is the most severe moment for the global silver market since the 1980 Hunt Brothers event. Second, the four driving factors of this crisis are China's export controls, leading to a sharp drop in supply, explosive growth in industrial demand, shorts being unable to hand over silver and forced to close positions, and the spot and futures prices starting to split, forming a dual track system. Third, today a silver bull. Bear dividing line is at $76 to $76.5. Strong support below is at $74.5 to $75 and $72.8 to $73. Key resistance above is at $78 to $78.7 and $80. Breaking through $80 will open space to the historical high of $83.5 to $84. Fourth, the 8th of January to 14th is the weight adjustment period. Violent fluctuations might occur. Do not panic and do not chase the rise or kill the fall. The 15th of January is the key turning point. If the price stabilizes, it will be the starting point of the main upward wave. Fifth, in this storm, physical is king. The rules of paper silver are formulated by Wall Street. They can modify the rules at any time to legally default on debts. But the physical attributes of silver are formulated by God. No one can change them. If conditions permit, allocating some physical silver as an anchor is your last line of defense against extreme risks. Finally, I want to leave an interactive topic for everyone in the comment area, which is also a time to test everyone's market sense. In the upcoming correction wave from the 8th of January to 14th, if the silver price truly gets knocked into a golden pit, at which point will you choose to fire? Will your first bullet be $74.5, $73, or do you plan to be more greedy and bet on a lower position? Please write your ambush price and reasons in the comment area. Let me see how many old hunters who are even more ruthless than me are hidden in our channel. This is just the beginning of our uncovering series. In the next video, I will lead everyone to shift our eyes away from the exchanges and dig deep into the darkest hour of the photovoltaic industry chain. I will expose the list of several giants that are about to face production shutdown crises because of the lack of silver, as well as those invisible winners who are frantically hoarding goods. That will be a real wealth treasure map. Please be sure to like, subscribe, and turn on the small bell. On this battlefield of asymmetric information, I don't want you to be the last person to know the truth and pay the bill. In 2026, the bigger the wind and waves, the more expensive the fish. Let us hold our chips tightly and wait together for that ray of dawn that belongs to us before the dawn of the new order.